Stop! Before you click off, this has happened to you. You placed a trade, clean setup, stop loss right below support, exactly where every course, every YouTube video, every mentor told you to put it. The market went straight to your stop, hit it, reversed, and left you watching the trade go to your exact target, of course without you in it. You called it manipulation, and you were right. For the next 24 hours, you're going to find out exactly what that looked like from the other side. Because you're not the retail trader anymore. You're the market maker. You don't predict the market. You don't trade the market. You are the market. Every bid, every ask, every spread, that's you. And your shift starts now. 6:45 a.m. Coffee. No alarm. You were already awake. You open the chart, not to read it, to check it. There's a difference. Retail traders read charts. You already know what the chart's going to do, because what the chart does depends largely on what you decide. You pull up the order book. There they are. Stops clustered just below the obvious support, right above the obvious resistance, exactly where every trading course told them to put their stops. It's a treasure map, drawn by the treasure itself. You write down 3 price levels. These are today's destinations. Good morning. 8:30 a.m. The bell rings. The retail flow arrives. They always arrive after the move. They saw the candle go green. They typed the ticker. They clicked buy. They think they caught it early. They didn't. You moved it so they would think that. You push price 9 pips above resistance. Clean break. Convincing. The breakout. Traders enter. Their stop sitting above the high, target 30 pips. Textbook setup. Textbook. You reverse. They didn't lose to you, they lost to the textbook. You just helped the textbook make its point. Somewhere right now, a retail trader is staring at a stopped-out trade, wondering what they did wrong. They followed the rules. That was the problem. Their problem, not yours. 10 a.m., Mike from Ohio just moved his stop 12 pips below support. Thoughtful. You drop price exactly 5 pips below, not 10, not 20, 5, surgical precision. The stops trigger, retail sells. You buy their positions at the bottom of the wick. Price reverses immediately. To them, it looks like a mysterious spike that came from nowhere, hit their stop with sniper precision, and reversed like it knew exactly what it was doing. It did know exactly what it was doing. You didn't hunt Mike personally. You just went where the stops were. Mike put them there. Again, not your fault. 12 p.m., you go sideways for 3 hours. Flat. Nothing. The chart looks like it fell asleep. Not because nothing is happening, because you're waiting. The impatient ones will close their trades by 1 p.m., frustrated by the stillness. The anxious ones will flip direction and pay the spread twice. The disciplined ones will hold, then second-guess themselves out of their position right before the actual move. You eat a sandwich. You have infinite patience. They have a lunch break, a risk manager sending passive-aggressive emails, and a P&L that is currently making them feel things. You win lunch. You always win lunch. 2 p.m. a macro number drops. Unexpected. Retail floods your book. Buying, selling, rebuying, selling again. Pure emotion dressed up as decision-making. This is your favorite hour. You widen the spread. Inventory risk is real, and your limits are real. But the practical result is this. The moment retail traders need the fairest price is the exact moment the price is least fair. The more afraid they are, the more it costs them to act on that fear. In 40 minutes, you made more than you made all morning. Fear is very, very good for business. You make a note to send a thank you card to whoever schedules macro announcements. 4 p.m. You've been pushing one direction all afternoon. Retail built positions with you. Some of them are in profit. One of them just told his girlfriend the trade is working. 4 p.m. You reverse. You need to close the day flat. Clean inventory, no overnight exposure. Standard position management. Your risk team insists, and your risk team is correct. To them, it looks like a betrayal. The market turned against them for no reason in the last 30 minutes of the session. To you, it's housekeeping. The retail P&L calls it Tuesday. 5 p.m. shift over. You power down the secondary monitors. You don't feel bad. You don't feel good. You feel like a vending machine that's been restocked. The mechanism worked. Again, the retail traders on the other side of your book today don't know your name. They know only that they clicked buttons, got prices, and somehow ended the day with less than they started. The spread was always there. You just made sure it worked for you, not them. Okay, now, step out of the chair. You're a retail trader again. And you know who else is? Mike. Mike from Ohio, who moved his stop 12 pips below support this morning. Remember? Mike, who the model went to, not because it knew his name, but because it knew exactly where he'd put his stop. You were Mike today. Every day you trade with a textbook in your hand, you're Mike. The market maker wasn't hunting you personally. There was no vendetta. No one sitting in a dark room with a photo of your account on the wall. There's just a model, a very efficient model. And the model goes where the stops are clustered, triggers the obvious levels, eats the impatient, and runs perfectly, entirely on predictability, your predictability. So the question was never, how do I beat the market maker? The question is, how do I stop being readable? That's what this channel answers. If you want the real psychology behind why you keep being predictable, why you keep handing the map to the treasure, subscribe. Because the shift starts again tomorrow. And right now, you're back on the wrong side of it.